Good morning. This is Jeff Cooper coming to you on December 5th with the market closed. And I'm happy to be back home after the Malibu fires. And of course, very happy to say that my house survived. Anyway, today we're going to talk about the $1,000,000 secrets for ringing the cash register on one-day declines, one-day waterfall declines. As traders, we're all looking to capture big moves in the shortest time frame. Risk, though, has to be measured by how long one is exposed to the market, not just in absolute returns. Today I'm going to walk through some $1,000,000 secrets I've learned over the past 30 plus years as a trader. First and foremost, fast moves often come from false moves. Also, fast moves often come when least expected, when there are no risk sirens blaring. Tuesday was such a setup. Why? As we offered on a report, after Monday's Trump trade truce rip higher on the heels of last week's Fed Powell coup as to interest rates, these were a virtual 1-2 knockout punch to the bears. The Powell push, right here, this green bar, was a 60-point rally that saw the S&P reclaim the midpoint of the year at 2737 on a closing basis. So things look good. Looks like we were in the clear, right? Then on Monday, the S&P exploded 40 points on the open on a supposed truce with China, which apparently was just an ad for Howie Mandel's return of a Deal or No Deal. We went on to state in Tuesday morning's report that any reversal left the market in a significantly weak position. Why? Because the vast majority of shorts had cried no mas and capitulated with that 1-2 rally punch, leaving scant buying fuel if the market turned back down. Likewise, with the perception of a successful W bottom right here on the November 20th test here of the late October spike low, that had the bulls jumping on the train, fearing it was leaving the station on a Santa Claus rally into the end of the year, and possibly even new highs if this neckline here of a potential inverse head and shoulders pattern, left shoulder, head, right shoulder, neckline, if that neckline was cleared, it actually projected to new all-time highs. What a better time to do so than December seasonality, right? So this combination of shorts having covered for the most part and longs doing an about face set up Tuesday's waterfall decline. As we stated in Tuesday morning's report, if the S&P moved back below 2760, which offset the gap from Monday, it could panic again. This is part of the $1,000,000 secret to capturing big one-day moves. A gap occurs, that is, offsetting a gap, what I referred to as a rabbit hole setup back through the rabbit hole. A gap occurs when the market is out of balance, when buyers swamp sellers, or vice versa. Monday, the index gapped up with authority, clearing its 200-day moving average in the process. That's this magenta line here. So not only did the gap back through, the move back through Monday's gap signal a rabbit hole setup, but it also reversed back through the 200-day moving average. These gaps are inflection points. If an item offsets a gap in short order, it is a sign of a reversal of fortune. Again, fast moves often come from false moves. Further on in this video, I'm going to walk through a handful of stocks to show how this played out in some individual names. Be that as it may, when the S&P knifed below Monday's gap at 2760, the wheels came off with a collapse to 2700, leaving one of the largest declines in 2018. It was a classic case of fast moves being derived from false moves. For example, on Monday, the S&P had reclaimed its 50-day moving average for the first time since knifing below it on October 10th, right here. The normal expectation would have been to see follow through, even after, a one-day pullback that turned the dailies down on trade below Monday's low. But it went much further than that, didn't it? The market has a memory. The S&P gapped above its 200-day moving average on October 16th here and spent 4 days hovering, but when the gap was offset or closed, the index broke badly to new 6-month lows. So you can see it gapped up here. When it went below that gap, another waterfall decline. Again, on November 7th, a one-day wonder, as we called it at the time, a gap up above the 200-day, spent a little less time hovering above it. Instead of 3 to 4 days here, spent 2 days above it. And when the gap was offset, a rabbit hole short setup was triggered, and the market knifed down to a test of late October lows. This time around, you had another gap up above the 200-day moving average. This time, presumably more constructive, as the S&P recaptured, or so seemingly so, recaptured its 50-day moving average. But not only did it stay above it for only 1 day compared to these last two occasions, it knifed back below it with authority at this bow tie of the 50 and 200-day moving averages, and now the S&P is in danger of carving out what is called a death cross when the 50-day moving average crosses below the 200. This is typically a confirmed bear market signal. Let's take a look at a 10-minute S&P, and we can see the action when the S&P buckled below 2760, as stated in Tuesday morning's report. So here's the gap up on Monday, 2760, and you can see the accelerated momentum when 27 to 60 is lost. Interesting, note the fractal on these 3 pivot highs on this little 10-minute chart compared to the 3 pivots above the 200-day that we just showed on the dailies. That was a tip-off, as was Tuesday's orb, which is an opening range break. I call an opening range the first 30 minutes range. I bracket that range, trade below the first 30 minutes range, as you can see here. Although the market didn't accelerate immediately, the orb did a good job of defining a trend day to the downside. It kind of just dribbled lower here, and then eventually, when it offset Monday's gap, it cratered. So I call these failed gap setups rabbit holes. When the gap is offset in short order, the tumble can be sharp. Let's walk through the signals and some individual names to see how they revealed their waterfall declines on Tuesday. First up is ePay, Bottom Line Technologies. Now, ePay was a short off our Monday night stock report for Tuesday's action. Despite the market strength on Monday, ePay, you can see here, left a large range outside down day on Monday despite this market strength. And note that this reversal on Monday was from an attempt to recapture its 20-day moving average, this red line. That's what I call a holy grail. In other words, stocks in a declining trend, when they rally back up to back test the declining 20-day moving average, that's a holy grail sell setup. Let's take a look at a 10-minute ePay to see how it played out. So looking at this 10-minute shows the acceleration once ePay triggered an opening range break. Here's the first 30 minutes range, and here's the opening range break right here. And as you can see, you got a strong extension and continuation, a little waterfall decline. Let's take a look at another stock that actually set up for lower prices. Sarepta Technologies. I'm going to take a look at the dailies first. Okay. SRPT actually left multiple sell signals on Monday. It backtested its 50-day line, right here, this blue line, carving out an NR 7-day in the process. An NR 7-day is simply the narrowest range in 7 days. In my experience, these NR 7 days are quickly followed, these contractions in range are quickly followed by an expansion of range, usually within the next 1 to 2 days. In this case, it came immediately. SRPT made an opening spike low. We'll take a look at the 10-minute to see what I'm talking about. Okay, so here's the open on Tuesday. SRPT makes an opening spike low, but when and rallied, but when an opening range break, trade below the first 30 minutes range, which was this opening spike low, when that was triggered, when an orb was triggered, an opening range break was triggered, SRPT plunged with authority. Note that the opening, the morning low pierced this gap nominally and rallied, at least attempted to. It knew the gap. That was a place where buyers stepped in and maybe some shorts covered. But when Monday's open gap was offset again, triggering this rabbit hole or failed gap setup, the second mouse got the cheese, and the SRPT tumbled another 6 points into the runoff. Often the most powerful rabbit hole setups, these failed gaps and downside orbs, come when there is no sell setup on the dailies, as there were with EPAY and SRPT. I want to take a look at two such names, Lam Research, LRCX, and EXAS. So let's take a look at LRCX. Exact Sciences is EXAS. Let's take a look at LRCX first. Okay, so here's a daily Lam Research. LRCX knifed below Monday's gap from the first 10 minutes of trade on Tuesday. You can see right here, right from the get-go. It triggered an opening range break on trade below the first half hour's low, indicating a trend day down. It was magnetized all the way back to last week's breakout point right here. Actually, it's still got a little room to go down to the 50-day. That will be an interesting inflection point. A continuation back down to the 50-day moving average where this breakout occurred, and you can draw a little trend line here. It broke out there. So that would be a place where, depending on market tone, might even set up a long side try. You can see that the 3-day chart turned up on this rally, and trade below Tuesday's low on Thursday will put LRCX in the +1. That's because the 3-day chart is pointing up, -2, followed by 2 consecutive lower daily lows. My +1 -2 buy setup could come into play on a back test of this 50-day moving average in sync with a back test of this pivot point, this breakout point. So let's take a look. That being said, let's take a look at the 10-minute, and you can see that this gap, Monday's gap, was basically offset right off the get-go, and you can see the waterfall decline. Again, nice rabbit hole gain, gap up, offset with a gap down. Let's take a look at EXAS dailies. So there was no, in fact, let's go back before we do that. Let's go back to the dailies. Is one other thing I want to show. You can see, in keeping with what I said earlier about fast moves coming from false moves, here you see a rule of 4 breakout, which is simply a breakout above little triple tops, or bigger picture triple tops for that matter. But you see this breakout, and on Monday, LRCX looked like it was in a strong position. You wouldn't want to have been short up there, theoretically. There was no reason to be short here after this breakout. Maybe you got a little consolidation, but you got a lot more than a little consolidation when this gap was offset. So when great expectations are discredited and people are leaning long, shorts have covered, as I said before with the S&P, and longs have stepped in. You have capitulation by the shorts. You have longs having gotten on board, and they recognize, the longs recognize, the bulls recognize when it's back below this gap that their first loss is their best loss, becomes a buyer's strike, and it's down for the count. So now let's take a look at EXAS. Exact Sciences. Here is a daily. Again, a rule of 4 breakout. EXAS actually makes all-time new highs on Monday, so it's shown great relative strength. It's one of the a handful of stocks, really, that never reached its 200-day moving average, this magenta line, throughout the fall decline. So EXAS was a name that we had on the long radar with subscribers on Monday, and it leapt to new all-time highs, breaking out over triple tops, as I said. Nevertheless, a down orb, an opening range break to the downside on Tuesday, left it suspect. Let's take a look at the 10-minute. So here's the first 30 minutes low, and trade below that triggered an orb. Sometimes you get an initial knee-jerk reaction, back up to resistance. This is the red line, the 20 period moving average on the 10-minute often acts as resistance, and that tied into the 50 period as well. But the second mouse got the cheese when it went below where the orb was triggered right here. And in fact, when the gap from Monday was offset for a rabbit hole sale, a follow-on sale, EXAS plunged an additional 2 points into the runoff from 78 down to 76, as you can see. So the interesting point here is that both LRCX and EXAS had broken above triple tops on their dailies triggering rule of 4 buy signals. Again, false moves often lead to fast moves. Combining the failures, at least in the short term, on the dailies with downside orbs, opening range breaks to the downside, and rabbit hole moves, offsetting gaps, offsetting Monday's gaps, were $1 million trifecta tickets for Tuesday's decline. So putting the pieces together, you had these opening range breaks in sync or in league with with the gaps being offset, and false moves, or to the upside or in the case of the first two stocks we showed, EPAY and SRPT, daily sell setups as well, with orbs triggering nice waterfall declines. So that's it for now. With that, I'll let you go. We'll be back again tomorrow morning. Appreciate your time. Thanks for listening.